program with no bias and no exemptions, including nothing but the truth. This is The Day Rice Show.
Hi everyone! Welcome back to our YouTube channel, which is The Day Rice Show. And to those who doesn't know us, please like and subscribe our YouTube channel and hit the notification bell for more updates of our videos. For this video, we're going to discuss, Chika, and to go deeper about the two topics, which is the milieu of the central bank that has the subject of financial system and also the objective of financial stability. But before that, let me introduce to you myself. Well, I am Lady May Saicon Morato, and together with my partner Rochelle Avila, I'm going to discuss about the milieu of the central bank that has the subject of the financial system, while she will discuss about the objective of financial stability. So, for no further ado, let's get started. Before we go deeper to our topic or discussion, let's know first about the meaning of milieu. Because of course, not everyone of us familiar or know the meaning of it. I researched it, and according to Google, it is defined as the person's social environment or the environment itself, or it is a physical or social setting in which something occurs or develops. So it means that the milieu of the central bank or the environment of the central bank, which has the subject of the financial system. Because central bank plays a significant role in financial system and in the real economy, it is striking understatement. A central bank is a financial institution that is responsible for overseeing the monetary system and the policy of a nation. Why central bank is the most important financial institution in the financial system? Because of course, central bank carry out a nation's monetary policy and control its money supply, often mandated with maintaining low inflation and steady gross domestic product or the GDP. So now we will know the subject of a central bank or who are involved in a central bank, because the subject of central bank is describes as the financial system in the concept of banking. So first is the lenders, which is the surplus economic unit, and the borrowers, which is the deficit of economic unit. So when we say lenders, those are the buyer, the buyer of the bond, while borrowers, those are the seller of the bond. Lenders try and earn maximum money surplus or surplus money, wherein they pay now and in exchange for a promises of future repayment, and that's how they earn from the central bank or in bank. Well, borrower, they try and pay the minimum of the money borrowed, and they will receive money now in exchange of a promises of their future repayment. The second subject is the financial intermediaries. If in the term of intermediaries, it is the means or the acting as the mediator, So it intermediate the lending and the borrowing process. They put themselves between the ultimate lender and ultimate borrower to maximize profit, and also it describes as the bank margin if it is based on the bank. And they attempt to pay least on deposit and also earn most on loans. Next is the financial instrument. Financial instrument is created to satisfy the financial requirement of the various participants. For example, treasury bills, which is marketable, and also the utilized bank overdraft facility, which is non-marketable. Fourth is the creation of money when demanded. As we all know that the bank have a unique ability to create their own deposits because we people, no, the public generally accepts that their deposits, or the money as a means of payment. Fifth is the financial market, no? For instance, institutional arrangement and convention that are being exist for the issue and dealing the financial instrument. The sixth and the last is the price discovery, which is the shares and the price of debt or the interest rates, no? Wherein it is being discovered. Next, we will go in the allied participants. So, the allied participants plays a significant role in terms of facilitating the lending and the borrowing process. And also, the funds manager who is actively involved in sophisticated financial analysis. Thus, there are also a non-participant principles. Those are the financial exchange and broker-dealers, the regulators, the funds managers, and the rating agencies. In Figure 2, which is banks on the financial system, it shows that the central bank holds debt securities and issues deposits, and it is involved in the interbank market. What it cannot illustrate is the central bank activities in the financial markets as buyer and seller of a certain securities called open market operations or OMO, and its major role in price discovery and money creation. In Figure 3, which is elements of the financial system, it is an attempt to depict most of the elements of the financial system and the allied participants.
Good day everyone, again my name is Rochelle Avila, and for today our next topic is all about the objective of financial stability. But first of all, let me explain to you what is financial stability, and later on we'll have to answer some questions regarding to this financial stability. So financial stability means it is a condition in which the financial system, the financial intermediaries, markets, and market infrastructures can withstand shocks without major disruption in financial intermediation and in the effective allocation of savings to productive investment. So financial stability has two legs or elements. First is the price stability, or it is a low and stable or non-volatile changes in the general price level, or generally referred to as the inflation rate. And in history, when inflation is low, then it tends to be non-volatile. And do you know that majority of the world tends to subscribe 2 to 3% per annum, which means that 2 to 3% per annum is tolerable and keeps deflation at bay. So the question here is that why is it 2 to 3% per annum and not 0%? Because 0% is too close to deflation or defaulted prices, which has a major negative impact on spending and investment. And the reason why 2 to 3% per annum is become tolerable, it is because the level of inflation has no material impact in the decision-making process of economic units. So it means that the rate of inflation should ideally be so low that it will not be so important factor in making economic decisions. And the second element of financial stability is the stable conditions in the financial system. So this is being accomplished when there is a high degree of confidence that the financial intermediaries and markets are stable, whereas if they were able to meet the obligations without any disruptions. And according to the ebook of the Central Banking and Monetary Policy, Central Bank clarifies these two elements of financial stability that they are closely related, because failure to maintain one of those elements can provide uncertain operating environment for the other. So with causality running in both directions. So it means that these two elements must reach or achieve together to have this so-called financial stability. And next we have a question, why financial stability, or is it important, or why is it important? So yes, financial stability is very important because it is essential in achieving a sustainable high growth and employment, and it is also fundamental to the creation of an economic environment that is conducive to the conduct of a business in both sides of GDP, respectively the demand and supply.
And we have here in the screen the formula of calculating the gross domestic product or the GDP.
So the gross domestic product here is measured by taking all the quantities of all goods and services produced, multiplying them by their prices, and summing the total. So it can also be measured by the sum of what is purchased in the economy or by what is being produced. So the demand can be divided into consumption, investment, government, imports, and exports. So take note that the fundamental to economic growth and the creation of employment are the stable production, consumption, and investment, which central banks are also centered of efforts to achieve and maintain this financial stability.
And next will be the things or measures that central bank can achieve financial stability domestically.
And the next element of the financial stability, which is the price stability, can be achieved domestically through the implementation of sound monetary policies in order to value of the currency. So generally, the achievement of financial stability is not the sole purpose or the sole responsibility of the central bank, because this responsibility is being shared with three agencies of the government, which is the Treasury, the Central Bank, and the financial regulators. And lastly, financial stability has also worldwide focus. It is the interrelatedness of the world's financial system or the problems of cross-border contagion. And the worldwide focus of financial stability happen based on by a number of developments that follows.
Among these developments have led to a number of international financial stability proposals, and the best example for this is the initiative to adopt key standards for sound financial systems, which cover the following areas.